Have you ever looked at your tax bill and thought, there's no way this number is right? Or maybe you've wondered how some people legally pay far less than others in the same income bracket. If you're looking to keep more of your hard-earned money in 2025 without breaking any rules, you're in the right place. Today, we're diving deep into practical, legal strategies you can use to reduce your tax bill in the US, Canada, and the UK. These aren't shady loopholes. These are real tools used by smart earners, business owners, and even everyday workers to keep more money in their pockets. Let's start with the golden rule of tax planning. It's not about how much you make. It's about how much you keep. And that comes down to knowing the rules of the game. First up, let's talk about retirement contributions. In the US, one of the easiest ways to reduce taxable income is by maxing out contributions to accounts like a 401k or a traditional IRA. In 2025, you can contribute up to $23,000 to your 401k if you're under 50, and up to $30,500 if you're 50 or older. That money goes in before taxes, meaning it lowers your taxable income dollar for dollar. If you're in a 24% tax bracket and you contribute $20,000, that's nearly $5,000 in taxes saved right there. Canada offers something similar with the RRSP, the Registered Retirement Savings Plan. Contributions to an RRSP are deductible from your taxable income. In 2025, the contribution limit is 18% of your earned income up to a maximum of $32,490. Again, less taxable income means a smaller tax bill. And in the UK, you've got pension contributions. Contributions to a personal pension are eligible for tax relief. Basic rate taxpayers get 20% added by the government, and higher rate taxpayers can claim additional relief through their tax return. It's free money, and it's cutting your tax bill in the process. Next, let's move to health savings and medical deductions. In the US, health savings accounts, or HSAs, are a triple tax win. Your contributions are tax deductible, the money grows tax-free, and withdrawals are tax-free when used for qualifying medical expenses. For 2025, the contribution limit is $4,300 for individuals and $8,650 for families. In Canada, while there isn't an HSA, you can claim medical expenses on your tax return if they exceed a certain percentage of your net income, typically 3%. So, keeping good records of your medical expenses, prescriptions, and even travel costs to medical appointments can help reduce your taxable income. In the UK, tax relief isn't as direct on medical expenses, but those with private health insurance through their employer can sometimes claim benefits depending on their plan structure. Let's switch gears to tax credits. Often misunderstood, but incredibly powerful. Unlike deductions, which reduce your taxable income, credits reduce your tax liability directly. In the US, if you have kids, the child tax credit is still a big deal in 2025. It's worth up to $2,000 per child under 17. Then there's the Earned Income Tax Credit, which can be worth thousands if you qualify based on income and family size. Education credits like the American Opportunity Credit and Lifetime Learning Credit are also worth exploring if you're taking classes or helping a dependent through college. Canadians have access to the Canada Workers' Benefit, the Disability Tax Credit, and tuition credits. And parents can claim child care expenses, which directly reduce taxable income, and in some cases result in a refund. In the UK, you might qualify for the marriage allowance, which lets one partner transfer part of their personal allowance to the other if one has a lower income. And don't forget the working tax credit and child tax credit, depending on your household income and situation. Now, let's talk about charitable giving. Across the board, in the US, Canada, and the UK, charitable donations can lead to tax benefits. But the trick is documentation. In the US, You can deduct up to 60% of your adjusted gross income if you itemize deductions and donate to qualified charities. In Canada, donations give you a non-refundable tax credit that increases the more you give. And in the UK, if you're a taxpayer, your donations may be eligible for gift aid, which allows the charity to claim back 25p every time you donate £1. Higher-rate taxpayers can also claim additional relief. Another great way to reduce your tax bill is by starting a side business. Whether it's freelancing, selling on Etsy, or consulting, running a business gives you access to a world of deductions. In the US, you can deduct home office expenses, internet bills, software, mileage, even a portion of your rent if you work from home. The key is tracking your expenses and keeping detailed records. Canada also allows business-related deductions if you have self-employment income. Think business supplies, advertising, and even meals while traveling for work. In the UK, sole traders can deduct many business costs from their profits, such as travel, office supplies, and some home utility expenses. And if you're operating under the flat-rate VAT scheme, you might even come out ahead depending on your industry. Here's a big one that gets overlooked: capital gains planning. In all three countries, how you sell investments matters. In the US, long-term capital gains, on assets held more than a year, are taxed at a lower rate than ordinary income. And if your income is under a certain threshold, you could pay 0%. In Canada, only 50% of capital gains are taxable. So managing when and how you sell investments can save you thousands. In the UK, the annual capital gains tax allowance for 2025 is £3,000, down from previous years, but it's still useful. Timing your asset sales to stay within this exemption can mean paying no tax at all on certain gains. Let's not forget tax software and professional help. If your taxes are simple, using tax software can guide you to available deductions and credits you might miss. But if you're a high earner, self-employed, or investing heavily, hiring a tax professional can pay for itself many times over. They know the ins and outs of the law and can help you plan in advance, not just file after the fact. So to recap, here are the key ways to reduce your tax bill in 2025. Max out retirement accounts like 401k, RRSPs, and pensions. Use health savings tools and track medical expenses. Take advantage of tax credits, especially for children, education, or low income. Donate to charity and keep receipts. Start a side hustle and claim legitimate business expenses. Strategically manage investments to reduce capital gains taxes. And when in doubt, talk to a pro. Reducing your tax bill isn't about doing less. It's about doing things smarter. If you found this video helpful, go ahead and hit that like button. It really helps the channel. If you've got a favorite tax-saving tip or a question about your situation, drop it in the comments below. And if you want more strategies like this, don't forget to subscribe and turn on notifications so you never miss an update. Thanks for watching, and here's to keeping more of what you earn in 2025.